A lot of retirees compare states by looking for one phrase: no state income tax. Once they see it, they think, good, that state is retirement friendly. Sometimes that is true, but sometimes that is only one part of the bill. A state may leave your IRA withdrawals alone, then hit you through property taxes. It may skip Social Security taxes, then make up for it at the cash register. It may look friendly in a headline, but once you add local taxes, sales taxes, and the kind of income you actually live on, the picture can change fast. That matters more when you are retiring with around $500,000. $500,000 sounds like a big retirement number until you turn it into monthly income. A 4% withdrawal is $20,000 a year, or about $1,667 a month before federal taxes. So if your state quietly takes an extra $2,000 or $3,000 a year, that is not a rounding error. That could be a Medicare premium, a utility bill, car insurance, prescriptions, or the money you thought would cover a trip to see family. That is why I built the Benji Knows Money Retiree Tax Drag Score. This is not a cheapest states list. It is not a ranking of where your whole retirement life will work best, and it is definitely not a pack the truck tomorrow list. This ranking asks a narrower question: which states create the fewest tax leaks for a retiree trying to make $500,000 last? For this score, I looked at the taxes that can actually hit a retiree's monthly life. What happens when money comes out of your IRA or 401k? What happens to Social Security? What happens if you work part-time? And what happens after that through property taxes, sales taxes, investment taxes, local taxes, and estate or inheritance taxes? Retirement income taxes got the most weight because that is where the money you actually live on shows up. Property taxes came next because they can keep billing you long after the mortgage is gone. That is the framework. It is not perfect and it is not personalized, but it is a lot better than ranking states by one phrase: no income tax. Look, we are going to count down the top 10 tax-friendly states for a $500,000 retirement from number 10 to number 1, and number 1 is not the state most people guess. One important boundary before we get into the list: this is general education, not personal tax, legal, or financial advice. State tax rules change. Local rules matter. Your own mix of Social Security, IRA money, pension income, home ownership, part-time work, and taxable investments can change the answer. Before making a real move, it is worth checking the current rules with a qualified tax professional. Number 10 is Iowa. Iowa may be the biggest surprise on this list. It does not have the same retirement state marketing machine as Florida or Nevada. Nobody hears Iowa and immediately pictures a beach chair, a tax brochure, and a drink with a tiny umbrella in it. But Iowa has become more interesting for retirees because of how it treats retirement income. Iowa now has favorable treatment for many retirees age 55 and older, including retirement distributions. That can matter if your $500,000 is mostly sitting in a traditional IRA or 401k. That part is easy to miss. $500,000 in a traditional retirement account is not the same as $500,000 sitting in a checking account ready to spend. Traditional retirement money still has taxes attached to it. You deferred the tax. You did not make it disappear. So if a state does not add another state-level tax bite when you withdraw that money, that can help. Iowa does not rank higher because property taxes can still matter. If you rent or own a modest home, the retirement income treatment may be the bigger deal. If you own a higher value home, the property tax bill may get your attention first. Here's the surprise with Iowa. It is not trying to win the retirement popularity contest. It just quietly improved the part of the tax code that can matter a lot to retirees with traditional retirement accounts. That is why Iowa makes the top 10. It is not flashy, but retirement tax planning does not need fireworks. It needs fewer leaks. Number 9 is Texas. Texas is the classic no-income tax state. That is the appeal. Texas does not add an income tax layer to Social Security, IRA withdrawals, 401k withdrawals, pension income, or part-time wages. If you plan to work a little in retirement, that can be a real advantage. But Texas also shows why no income tax cannot be the whole analysis. Property taxes are the catch. The state may not tax your income, but the property tax bill can still show up every year like it owns part of the house. For a retiree, that matters because property taxes do not retire when the mortgage does. You can pay off the house and still have a housing tax bill that follows you around with a clipboard. So Texas ranks well, but not at the very top. For a renter, Texas may look stronger. For a homeowner in a higher tax county, the story may look different. That is the Texas lesson. No income tax can help a lot, but it does not make housing costs disappear. And your retirement budget does not care what category the bill uses. It only cares that the money left. Number 8 is New Hampshire. New Hampshire is the state where the receipt looks better, but the property tax bill can look worse. It has two features people love: no broad wage income tax and no sales tax. That can help if you still plan to work part-time. And no sales tax feels good because the total at the register does not suddenly grow a second head. But New Hampshire's trade-off is property taxes. The state is well known for higher property tax pressure, and that can matter a lot if you plan to own a home there. So the New Hampshire question is not simply, is this state tax-friendly? In many ways, yes. The better question is, which tax will matter most in your retirement life? If you rent, own a modest home, or are very intentional about the property you buy, New Hampshire can work better. If you buy a more expensive home, the property tax bill may take back a lot of the advantage from having no wage income tax and no sales tax. New Hampshire is strong, but it is not simple. And in retirement, simple matters. The fewer surprises your budget has, the easier it is to sleep. Number 7 is Delaware. Delaware is the quiet sleeper on this list. It does not get the same attention as the big no-income tax states, but it does several things retirees care about. The big one is no sales tax. That matters more than people think. Sales tax does not arrive once a year and make you sit down at the kitchen table with a calculator. It shows up in the background through clothes, household supplies, repairs, restaurant meals, and all the normal purchases that keep a home running. Delaware also tends to have a favorable property tax profile compared with many states. That combination can help retirees who are trying to protect monthly cash flow. Now, Delaware is not a no-income tax state. That is why it does not outrank the cleanest tax states on this list. But Delaware proves an important point. A state can still have income tax and be attractive if it plugs enough other leaks. For someone retiring with $500,000, that can matter. You may not need the state to be perfect. You need the state to stop taking unnecessary bites from the parts of your budget you rely on most. Delaware is not loud. It just makes the math worth checking. Number 6 is Alaska. Alaska is the state with the giant tax headline and the giant lifestyle asterisk. On paper, Alaska looks extremely strong because it has no state income tax and no statewide sales tax. If we were only ranking the headline tax structure, Alaska would look almost unbeatable. But retirement does not always reward easy headlines. Alaska has local variation. Some localities can have sales taxes. And while this is not a cost of living ranking, you cannot ignore practical issues that matter to retirees, like distance, healthcare access, transportation, weather, and the cost of getting things where they need to go. Those are not all taxes, but they still affect real retirement life. So Alaska ranks high on tax structure, but it comes with a large asterisk. From a tax standpoint, Alaska can be excellent. From a total retirement standpoint, it depends heavily on your lifestyle, location, health needs, and tolerance for living somewhere that is not exactly easy mode. That is not a criticism of Alaska. It is the difference between a tax ranking and a retirement decision. A tax-friendly state tells you where the government may take less. It does not tell you if your monthly life will work. Number 5 is Tennessee. Tennessee is income-friendly but sales tax heavy. That is the whole story, in plain English. Tennessee has no state income tax, so it does not add a state income tax layer to retirement withdrawals, Social Security, pension income, or part-time wages. That can matter a lot for someone retiring with $500,000 because many people in this savings range may not be fully done working. You may semi-retire, consult, work 2 days a week, do seasonal work, or keep some income coming in until Social Security, Medicare, or the portfolio feels more settled. In that case, no wage income tax can make part-time work more useful. But Tennessee has a clear catch: sales tax. Even though the state may not tax your income, it can still tax your spending. And retirees spend money every month. Groceries, household goods, services, supplies, restaurant meals, clothing, and repairs all still happen after the paycheck stops. You may not be buying a new couch every week, but you are still buying life. So Tennessee is strong on income taxes, but it is not tax invisible. Some states tax you when you earn, some tax you when you own, some tax you when you spend. Tennessee's advantage is that it leaves income alone. The catch is that the register still gets a vote. Number 4 is Nevada. Nevada is tax-friendly but not automatically cheap, and that sentence matters. Nevada's big advantage is that it does not put a state income tax layer on the retirement income most people use. Social Security, IRA withdrawals, 401k withdrawals, pensions, and part-time wages are not getting hit by state income tax. Nevada also has a relatively low property tax burden compared with many states. So for many retirees, it does well on 2 big categories at once: income and property. And that is why Nevada ranks so high. However, sales taxes are part of the reason it does not land at number 1. And more importantly, Nevada's tax score does not tell you whether Las Vegas, Henderson, Reno, or another popular area fits your real budget. Housing and insurance realities can be separate from the tax code, but they still take money from the same checking account. That is where a lot of online state lists get sloppy. They say Nevada is tax-friendly, and the viewer hears, Nevada will make retirement easy. Those are not the same sentence. Nevada can reduce state tax drag. That is valuable. But if the rest of your monthly life is expensive, the budget still feels pressure. A low-tax state can help a $500,000 retirement breathe. However, it cannot do CPR on a budget that was already gasping. Number 3 is Florida. Florida is the one everybody expects, and yes, Florida belongs near the top. Its tax appeal is straightforward: no state income tax. That means Florida does not add a state income tax layer to Social Security, retirement account withdrawals, pension income, or part-time wages. For someone retiring with $500,000, that can protect several of the income streams that matter most. That is why Florida has been a retirement magnet for so long. But let me be real with you. Florida is also the best example of why this is a tax ranking, not a total affordability ranking. Florida's tax profile can be excellent while the full retirement budget still gets complicated. Homeowners insurance, HOA fees, housing prices in popular areas, and storm-related costs are not state income taxes, but they still take money from the same checking account. That is why I would not say, move to Florida and $500,000 is enough. It just does not work that way. Florida helps on taxes. It does not erase the rest of retirement. Still, on a tax-only ranking, Florida deserves the top tier. If your main goal is reducing state tax on retirement income and work income, Florida is one of the strongest states in the country. Just remember the difference between a lower tax bill and a lower life bill. Those are related, but they are not the same thing. At number 2 is South Dakota. South Dakota is the simplicity pick. No state income tax means the common retirement income streams stay cleaner from a state income tax standpoint. Social Security, IRA withdrawals, 401k withdrawals, pension income, and part-time wages do not get hit by state income tax. That does not mean South Dakota has no taxes at all. Sales taxes, property taxes, and local costs can still matter. South Dakota also does not have an estate or inheritance tax. That simplicity is a major advantage. Now, no state is tax-free. South Dakota still has sales taxes and property taxes. Your local area still matters. But in the Benji Knows Money Retiree Tax Drag Score, South Dakota ranks very high because it does not create a lot of state-level friction around the income retirees commonly use. That can be especially useful when your retirement plan is already tight. If your $500,000 has to last, fewer state tax complications can make planning easier. South Dakota will not fit everyone. Weather, healthcare access, family, lifestyle, and housing all matter. But from a tax standpoint, South Dakota is one of the strongest states on the board. Now that brings us to number 1. And no, it is not Florida, Texas, or Nevada. Finally, at number 1 is Wyoming. Wyoming wins because it is strong across several categories, not just one, and that is the key. Some states make the list because they are excellent on income taxes but weaker somewhere else. Some look good for retirees who rent, but less good for retirees who own a home. Some protect retirement income, then quietly take more through sales taxes or property taxes. Wyoming's advantage is that the tax picture is cleaner across the board. It has no state income tax, so retirement withdrawals, Social Security, pension income, and part-time wages are not getting hit by a state income tax layer. It also has low property tax pressure compared with many states, relatively low sales tax compared with many states, and no estate or inheritance tax. That combination matters because a $500,000 retirement does not usually have room for 5 different tax leaks at once. Wyoming does not just plug one leak, it plugs several. That is why it rises above states that may have one big tax advantage but a bigger trade-off somewhere else. Now, that does not make Wyoming perfect. No state is perfect. Taxes cannot answer questions about doctors, family, climate, lifestyle, housing supply, winter, distance, or whether you actually want to live there. But in a tax-only ranking, Wyoming has one of the cleanest combinations in the country. That is why it lands at number 1. Before we wrap this up, it is worth briefly looking at the other end of the list. In the Benji Knows Money Retiree Tax Drag Score, the states ranked 41 through 50 had the heaviest retiree tax drag in this model. Maryland, Maine, Nebraska, Massachusetts, Rhode Island, Connecticut, Vermont, Minnesota, New York, and California, in that order. That does not mean nobody can retire well in those states. Plenty of people do. It also does not mean moving is automatically the answer. Family, health care, housing, community, and quality of life may matter more than the tax bill. But it does mean you have to be more careful with the math. In these states, the pressure may come from income taxes, property taxes, estate taxes, local taxes, or some combination of all of them. A high-tax state does not make retirement impossible. It means your plan needs to be honest about the full cost of staying and not moving to another state. So what do you actually do with this ranking? Here's the practical part. Do not use it like a moving checklist. Use it like a filter. Start with your income mix. Are you mostly living on Social Security, drawing from a traditional IRA or 401k, or collecting a pension? Are you working part-time, owning a home, using taxable investments, or trying to leave money to heirs? Your answers to those matter more than the state's marketing slogan. The best tax state for your neighbor may not be the best tax state for you. A retiree with a paid-off home may care deeply about property taxes. A renter may care more about income taxes and sales taxes. A retiree with mostly Roth money may care less about state taxes on retirement withdrawals than someone whose nest egg is mostly in a traditional IRA or traditional 401k. And if you plan to work part-time, state income tax on wages may matter more than it would for someone who is fully done working. That is the practical way to use the list. Don't ask, which state has the lowest tax? Instead, ask, which state taxes my kind of retirement income the least? That is especially important with $500,000 because the margin is not unlimited. A few $1,000s a year can matter. $3,000 a year is $250 a month. That might be a utility bill, a car insurance bill, a Medicare supplement premium, a prescription gap, a trip to see family, or just enough breathing room to keep every month from feeling like a budget meeting with bad lighting. Taxes are not the whole retirement plan. Housing, healthcare, insurance, family support, weather, and whether you actually want to live there all still matter. And most of the time, that last statement gets overlooked more than it should. A low-tax state does not help much if you are miserable and flying back home 6 times a year. But taxes still matter because they are one of the few retirement costs you can study before the surprise shows up. No income tax is useful, but it does not make the rest of the tax bill disappear. A state can skip income tax and still lean on property taxes. It can have no sales tax and still hit homeowners. It can exempt retirement income but still tax wages or investment income. The tax code is not one door, it is a hallway. So before making a relocation decision, put your actual income on paper. Social Security, IRA, or 401k withdrawals, pension income, part-time wages, and taxable investments. Then, ask how the state treats those exact dollars. After that, look at property taxes, sales taxes, and local rules. That order keeps you from being distracted by the state's best advertisement. Every state wants you to notice its best tax feature. Your retirement budget needs you to notice the feature that affects you. The thing most people miss is this. The final question is not, should I move to Wyoming, South Dakota, Florida, Nevada, Tennessee, or Texas? The better question is, which state lets more of my actual retirement income stay in my actual retirement life? That is the question worth answering. If this helped you see the tax leaks behind the ranking, subscribe to Benji Knows Money. That is what we do here. Turn retirement numbers into real-life decisions before they turn into surprises. And in the next video, we are going one layer deeper into the same problem, how state taxes can shrink a $500,000 retirement. The ranking tells you where the tax drag may be lower. The next step is seeing what that drag can actually do to the money you were counting on.